Listen, I want you to picture something. A Sunday evening in October of 2025, a dining room table in a craftsman house in Portland, Oregon. Her name is Susan. She is 63 years old. She spent 29 years as a financial controller for a regional healthcare system. She understands income statements. She understands tax schedules. She spent 3 decades closing the books every month, and she is not intimidated by numbers. Susan retired 8 months ago. She has a traditional IRA with $620,000 in it. She has a rental property in suburban Portland generating $2,400 per month in gross rent. She has a taxable brokerage account at Vanguard with $280,000 in dividend-paying equity funds. She has a small pension from her employer of $1,100 per month, and she has Social Security waiting. Her projected benefit at 67, her full retirement age, is $3,200 per month. At 70, it grows to $3,968 per month. Susan has 4 years to decide when to file. She is using those 4 years to let the IRA compound, to collect rent, to receive her pension, and to draw dividends from the brokerage account. She thinks she is being patient. She thinks she is being strategic. She is watching 4 income streams run at full throttle while the Social Security clock ticks toward the filing date. And not one of those 4 streams has been configured for what happens when the 5th stream, the Social Security check, joins the income picture. And the provisional income calculation under Internal Revenue Code Section 86 converts what felt like a comfortable retirement into a 22% effective tax surcharge on every dollar those 4 streams produce above the threshold she never modeled. Susan is sitting at the dining room table on a Sunday evening because she got a call on Friday from her CPA. He ran the numbers for the year she files for Social Security. He is calling her before tax season because he is the kind of CPA who does that. He told her that in the year she files, with all 4 income streams running at their current configuration, alongside $47,616 per year in Social Security, her provisional income is going to be $118,400. The married filing jointly threshold for 85% Social Security inclusion is $44,000. She is going to be $74,400 above it. She is going to have $40,474 of her Social Security benefit taxed as ordinary income. She is going to pay an effective combined federal and Oregon state rate on those 4 income streams that is 22 to 28 percentage points higher than she is paying today on income that has not increased by a single dollar. That is the restructuring gap. That is what 4 income streams running in their default configuration cost a retiree the moment Social Security starts. And that is what we are spending the next 30 minutes dismantling, stream by stream, dollar by dollar, with the real math, the real thresholds, and the real instruments available to Susan in the 4 years she still has before the first Social Security check arrives and the provisional income machine activates permanently. Smash the like button right now. The algorithm in 2026 is burying content that explains the provisional income interaction in the context of multiple retirement income streams, because the financial services industry profits from each of those streams in their current configuration and has no incentive to restructure them. Every like on this video breaks the suppression. Hit it, subscribe, flip the bell. The Suits and Legal want me to say this is not financial advice. Fine, this is not financial advice. This is a forensic examination of how 4 specific income stream types interact with Internal Revenue Code Section 86 and what the restructuring options are before the interaction becomes permanent. Consult a fee-only fiduciary who has modeled provisional income across multiple income sources. What I can do is show you the math. Let me start with the mechanism because the provisional income calculation is the engine that powers everything that follows. And understanding it precisely is the difference between a plan that works and a plan that looks like it works until the first Social Security check arrives. Internal Revenue Code Section 86 defines provisional income as adjusted gross income plus tax-exempt interest plus 1/2 of Social Security benefits. That total is compared against 2 thresholds. For married filing jointly, if provisional income is below $32,000, none of Social Security is taxable. Between $32,000 and $44,000, up to 50% is taxable. Above $44,000, up to 85% is taxable as ordinary income. For a single filer, the lower threshold is $25,000 and the upper is $34,000. The thresholds have not been adjusted for inflation since 1983 and 1993 respectively. This is not an oversight. This is a structural mechanism that guarantees an increasing percentage of retirees cross the threshold with every passing year of inflation, without any corresponding increase in their benefit. And here is the phantom multiplier that nobody puts in the planning document. For every dollar of income above the $44,000 threshold, you generate $1.85 of taxable income. The original dollar plus 85 cents of Social Security dragged into the taxable column. Your effective marginal rate on income above the threshold is your stated bracket multiplied by 1.85. At the 22% federal bracket, the effective marginal rate on the income generating the Social Security cascade is 40.7%, not 22%, 40.7%, on top of whatever state income tax applies. In Oregon, where Susan lives, state income tax reaches 9.9% at income levels she will be at. Her combined marginal rate on income above the provisional income threshold, accounting for the 1.85 phantom multiplier and the Oregon state rate, approaches 50 cents of every marginal dollar going to taxes. That is the restructuring imperative. That is why the 4 streams matter. That is why the configuration of those streams in the 4 years before Social Security starts is the most consequential tax planning period of Susan's financial life. Now let me name the 4 income streams and show you what each one does to the provisional income calculation and what restructuring it before Social Security starts actually accomplishes. Income Stream 1. The traditional IRA generating voluntary distributions during the pre-Social Security years. Susan is pulling $40,000 per year from her traditional IRA to supplement her pension and cover living expenses while she delays Social Security. Each dollar of that $40,000 distribution is ordinary income. Each dollar enters the adjusted gross income calculation. Each dollar feeds the provisional income formula, and each dollar above the $44,000 threshold, when Social Security starts, generates 85 cents of additional taxable Social Security on top of itself. The distribution Susan takes voluntarily from the IRA in 2025 at the 22% bracket costs her $8,800 in federal tax. The same $40,000 distribution in 2028, when Social Security is running, costs her $8,800 in direct federal tax, plus the 22% rate on $34,000 of additional Social Security income dragged into the taxable column at $7,480. The same withdrawal costs $16,280 in federal tax in 2028 versus $8,800 in 2025. Not because the bracket changed, because Social Security activated the phantom multiplier. The restructuring for Income Stream 1 is the Roth conversion executed during the pre-Social Security window. Susan is 63. She has 4 years before she plans to file at 67. In each of those 4 years, she can convert a calculated amount from the traditional IRA to a Roth IRA, paying the income tax at her current marginal rate in a year when Social Security has not yet activated the phantom multiplier. The conversion math is straightforward. Her baseline income from the pension is $13,200 per year. The standard deduction for married filing jointly in 2026 is approximately $30,600. Her taxable income from the pension before any conversion is negative after the standard deduction. She has the full width of the 12% and 22% federal brackets available for Roth conversion income. The top of the 22% federal bracket for married filing jointly in 2026 is approximately $201,050 of taxable income. Susan can convert up to approximately $218,000 from the traditional IRA to Roth in 2026 while staying inside the 22% bracket. She does not need to convert that much in a single year. A controlled conversion of $60,000 to $80,000 per year over 4 years moves $240,000 to $320,000 from the traditional account to Roth before Social Security starts. That $240,000 to $320,000 in the Roth will never generate a provisional income event. It will never enter the Section 86 formula. It will never drag Social Security into the taxable column. Every dollar converted now at 22% federal is a dollar that will not generate 40.7% effective marginal cost when Social Security starts. The conversion pays for itself within 3 to 5 years of Social Security filing through the avoided phantom multiplier cost. Income Stream 2. The rental property generating ordinary income every month. Susan's rental property produces $2,400 per month in gross rent, $28,800 per year. Against allowable deductions, mortgage interest if any, depreciation, property taxes, maintenance, insurance, management fees, her net taxable rental income after Schedule E deductions is approximately $14,000 per year. That $14,000 is ordinary income. It enters adjusted gross income. It feeds the provisional income calculation. At the 85% inclusion threshold above $44,000, that $14,000 of net rental income generates $14,000 in direct taxable income, plus $11,900 of additional Social Security inclusion, a total income effect of $25,900 from $14,000 of rental cash flow. The effective tax on the rental income after the Social Security cascade is not the 22% marginal rate on $14,000. It is the 22% rate on $25,900, which equals $5,698. Susan thought she was paying $3,080 in federal tax on $14,000 of rental income. She is paying $5,698. The rental property's true after-tax cash flow is materially lower than the gross numbers suggest because the provisional income interaction is invisible on the Schedule E and invisible on the Social Security statement and never appears on any single tax form in a way that reveals the compounded cost. The restructuring options for rental income in the context of Social Security provisional income are more limited than for an IRA, because the rental income is tied to a physical asset that generates cash flow regardless of the retiree's tax situation. But 3 interventions can reduce the taxable rental income. Accelerated depreciation through cost segregation allows commercial and residential rental properties to front-load depreciation deductions into the early years of ownership, rather than distributing them evenly over 27.5 years for residential property. A cost segregation study on Susan's rental property might identify personal property components, appliances, carpeting, fixtures, land improvements that qualify for 5-year or 15-year depreciation rather than the standard 27.5-year schedule. Accelerating that depreciation into the pre-Social Security years increases the deductions on Schedule E, reduces net rental income, and reduces the provisional income that will interact with Social Security when the benefit starts. The cost of a cost segregation study for a single residential rental property is approximately $3,000 to $6,000. If it identifies $30,000 of accelerated depreciation that can be taken in the pre-Social Security years at Susan's 22% bracket rather than the post-Social Security years, where the effective rate on that income approaches 40%, the tax savings from the timing difference alone are approximately $5,400. The second intervention is the installment sale of the rental property before Social Security starts, structured to spread the capital gain recognition across multiple years rather than concentrating it in a single year. If Susan intends to eventually sell the rental property, doing so before Social Security filing keeps the annual gain recognition below the provisional income threshold in each installment year. The third intervention, available once she reaches 70 and a half, is the Qualified Opportunity Zone investment, or the 1031 exchange into a Delaware statutory trust that reduces active management obligations and potentially converts the rental income from ordinary Schedule E income into a more tax-manageable structure. These are more complex instruments that require specific professional guidance, but they exist as tools for the retiree with rental income who wants to reduce the provisional income impact without selling the asset outright. Tell me in the comments right now. Tell me whether you have rental income as one of your retirement income streams. Tell me your state, your approximate net rental income after deductions, and whether you have modeled the provisional income interaction between your rental income and your Social Security benefit. Drop it in the comments. We map the interaction together. Income Stream 3. The taxable brokerage account generating qualified dividends and capital gains distributions annually. Susan has $280,000 at Vanguard in dividend-paying equity funds. At a blended dividend yield of approximately 1.8% in 2026, her annual dividend income is approximately $5,040 per year. Those dividends are qualified dividends taxed at the 15% preferential federal rate. The direct income tax on $5,040 of qualified dividends at 15% is $756. Manageable. Completely invisible as a problem until the Section 86 interaction is modeled. Here is the problem. Qualified dividends enter adjusted gross income. They enter the provisional income formula. At the 85% inclusion rate above the $44,000 threshold, Susan's $5,040 of qualified dividends generates $5,040 in adjusted gross income, plus $4,284 of additional Social Security inclusion as ordinary income. Total income effect from the dividend, $9,324. Federal tax on the additional $4,284 of ordinary Social Security income at 22%, $942. Total federal tax consequence of the $5,040 dividend, $756 direct plus $942 Social Security cascade equals $1,698. She is paying $1,698 in total federal tax on $5,040 of dividend income. That is an effective rate of 33.7% on a dividend that the tax code nominally taxes at 15%. The difference between 15% and 33.7% is the Social Security cascade, operating silently, invisible on any single form, disclosed nowhere in the Vanguard quarterly statement. The restructuring for Income Stream 3 involves two interventions that can be executed before Social Security starts. The first is repositioning the dividend-paying equity funds inside the taxable account into tax-managed equity funds, or individual stock positions that minimize annual dividend distributions. Total return equity strategies that generate appreciation through price growth rather than dividends reduce the annual income recognition in the taxable account without reducing the investment exposure. The capital gain is recognized when the fund is sold rather than distributed annually. The retiree controls the timing of the recognition and can choose years when their provisional income is low to realize gains at the 0% federal long-term capital gains rate, which applies to married filing jointly taxable income up to approximately $94,050 in 2026. The second intervention is the migration of dividend-producing positions from the taxable account into the Roth IRA over time through systematic Roth contributions or through the Roth conversion of traditional IRA assets in exchange for holding the dividend-paying positions inside the taxable account in a lower yield configuration. The Roth holds the dividend-paying assets. The dividends accumulate tax-free inside the Roth. They never enter the provisional income calculation. The taxable account holds the low dividend, high appreciation positions. The taxable account's annual income generation is minimized. The provisional income machine is starved of the input it needs to cascade Social Security into the taxable column. Income Stream 4. The pension-generating fixed monthly ordinary income for life. Susan receives $1,100 per month, $13,200 per year, from her former employer's defined benefit plan. That pension income is ordinary income. It enters adjusted gross income every year. It is fixed. It cannot be restructured, deferred, or repositioned. Susan cannot renegotiate the pension payment schedule with her former employer's pension administrator. The pension is what it is. But the pension's role in the provisional income calculation makes it the foundation against which every other income stream must be calibrated. Because the pension generates $13,200 of irreducible ordinary income every year, Susan's provisional income baseline before Social Security, before IRA distributions, before rental income, before dividends, is already $13,200. When Social Security starts at $47,616 per year, half of that, $23,808, enters the provisional income formula. The combined baseline from pension plus half of Social Security is $37,008. That is already above the $32,000 lower threshold, where 50% of Social Security becomes taxable. Susan is above the lower threshold before she takes a single dollar from the IRA, before she collects a dollar of rent, before she receives a dollar of dividends. The only question is how far above the $44,000 upper threshold she ends up, which determines whether 50% or 85% of her Social Security is taxable, and how large the phantom multiplier impact is on each of the other three income streams. The restructuring implication of the irreducible pension is that Susan must configure the other three income streams around the pension baseline rather than in isolation. The pension occupies the bottom of the provisional income stack. Every other stream stacks on top of it. The Roth conversion of IRA assets removes future IRA distributions from that stack. The reduction of taxable brokerage dividends reduces the stack further. The cost segregation or sale of the rental property reduces the net rental income in the stack. The goal is to engineer the combined stack of provisional income sources so that the total, including Social Security's own half contribution to the formula, lands as close as possible to, but below, the $44,000 upper threshold in every year that Social Security is being collected. In Susan's case, the math works out as follows. Pension of $13,200. Half of Social Security of $23,808, combined baseline provisional income, $37,008. The available headroom to the $44,000 upper threshold is $6,992. If Susan converts the IRA to Roth before Social Security starts and eliminates future IRA distributions from the provisional income stack, and if she reduces the taxable brokerage dividend yield to below $7,000 per year through repositioning, and if the cost segregation study reduces her net rental income by $8,000, her combined provisional income in the year Social Security starts would be approximately $43,500, below the 85% inclusion threshold. The fraction of her Social Security that is taxable drops from 85% to approximately 50%. The phantom multiplier drops from 1.85 to 1.50 on the marginal dollars of income above $32,000. Her effective marginal tax rate on income above the lower threshold drops from 40.7% to approximately 33%. The four-stream restructuring moves the effective marginal rate down by nearly 8 percentage points. On $100,000 of total income, that is $8,000 per year of federal tax that does not get paid. On a 20-year retirement, that is $160,000 of federal tax that does not get paid, because 4 income streams were configured before Social Security started rather than after. Now let me give you the regional dimension, because the state tax interaction with the provisional income cascade varies enormously and determines the true combined marginal rate on each dollar above the threshold. In Oregon, where Susan lives, the state income tax rate at her income level is 9.9%. Oregon does not exempt Social Security income from state income tax. The full amount of taxable Social Security after the Section 86 calculation is taxed at the 9.9% Oregon rate. Combined with the 22% federal rate and the 1.85 phantom multiplier, Susan's effective marginal rate on income above the provisional income threshold approaches 50 cents per dollar in Oregon. The restructuring imperative in Oregon is stronger than in almost any other state. In Florida, there is no state income tax. The provisional income interaction costs Susan the federal rate only. The 22% federal bracket multiplied by the 1.85 phantom multiplier produces an effective marginal rate of 40.7% on income above the threshold. Still punishing, still worth restructuring, but the Florida retiree's restructuring benefit is the federal saving alone, which on a 20-year retirement with $100,000 of annual income is substantial without the additional Oregon state layer. In Illinois, pension income from a qualifying retirement plan is exempt from Illinois state income tax under the Illinois Income Tax Act. But Illinois does tax Social Security income at the state rate after the federal Section 86 calculation determines the taxable portion. The Illinois retiree with a pension is in a partially favorable position because the pension itself escapes state taxation, which reduces the baseline provisional income's state tax cost. But the Social Security dragged into the taxable column by the cascade is still subject to Illinois state income tax at the 4.95% flat rate. In Texas, there is no state income tax, and the provisional income interaction costs only the federal rate. The Texas retiree with Susan's income profile who executes the 4-stream restructuring before Social Security starts achieves the maximum available after-tax benefit because every dollar of avoided phantom multiplier tax is a dollar of purely federal savings with no state layer reducing the net gain. Now let me give you the action sequence. 5 steps. What Susan is doing in the next 30 days and the next 4 years to restructure the 4 income streams before Social Security activates the provisional income machine. Step 1. Calculate the provisional income baseline today using only the income sources that are fixed and not restructurable. In Susan's case, that is the pension of $13,200 plus half of her projected Social Security benefit of $23,808, totaling $37,008. That baseline tells her how much headroom she has to the $44,000 threshold, which is $6,992. Every dollar of restructurable income above $6,992 that she can remove from the provisional income formula is a dollar that avoids the phantom multiplier. Step 2. Model the Roth conversion ladder for the pre-Social Security years. Calculate the maximum annual conversion that stays inside the 22% bracket given her current income from the pension and any other fixed sources. For Susan, that maximum annual conversion is very large because the pension income after the standard deduction generates minimal taxable income alone. She should be converting aggressively in the 4 years before filing, prioritizing the conversion over other uses. Step 3. Commission a cost segregation study on the rental property. Get 2 quotes from cost segregation specialists. Evaluate whether the accelerated depreciation generated by the study, taken in the pre-Social Security years at the 22% bracket, produces enough tax savings to justify the study cost. If the study identifies $30,000 or more in accelerated depreciation, the answer is almost certainly yes. Step 4. Reposition the taxable brokerage account dividend yield downward. Identify the highest yielding positions in the account. Evaluate whether low dividend equivalents with comparable risk profiles exist that can replace them without meaningfully changing the investment exposure. The goal is to shift return from annual dividend income to unrealized appreciation that enters provisional income only when realized, at a time of Susan's choosing. Step 5. Build the provisional income model for the year Social Security starts using the restructured income stack. Add the pension, the projected net rental income after cost segregation, the projected brokerage dividends after repositioning, and half the Social Security benefit. Compare the total to the $44,000 threshold. If the total exceeds the threshold, identify the remaining restructuring opportunity. If the total is below or near the threshold, the restructuring has achieved its goal. No phantom multiplier cascade. Save this video right now. Hit the save icon. Add it to the retirement survival playlist, because the 4 income streams running in their default configuration are not a problem today. They are a problem in the year Social Security starts. And the difference between a problem that is solved and a problem that is paid is the planning that happens in the years before the first check arrives. Susan's CPA called on a Friday in October because he is the kind of CPA who models the interaction before the tax bill arrives. Most CPAs are not. Most financial planners are not. Most retirement income discussions focus on the total income number and the gross return on investments in the Social Security benefit amount. Almost none of them model what 4 income streams do to each other. Almost none of them model what 4 income streams do to each other in the presence of the Section 86 provisional income formula and the phantom multiplier that sits inside it. That modeling is what this archive is built to provide. Subscribe if you have not. Flip the bell. Comment with your 4 income streams. Tell me your pension amount if you have one. Tell me your rental net income if you have a property. Tell me your brokerage dividend yield. Tell me your traditional IRA balance and your projected Social Security benefit. We build the restructuring model together in the comment section. I read every single one. The 4 income streams are not the enemy. The configuration is the enemy. The default configuration was built for a different tax environment, a different provisional income threshold, a different relationship between income streams and Social Security that existed when each stream was established separately. You are not living in separate financial decisions. You are living in a system. Model the system before Social Security turns it on. I will see you in the next one. Stay liquid, stay strategic, stay furious. The provisional income threshold has not moved since 1983. Your income has moved. Your portfolio has moved. Your retirement date is moving. The only thing that should not move is your resolve to configure the 4 streams before the machine activates. Configure them now. The window is open. Use it.